Hello, welcome back to Learn Economia. Today we are going to discuss the very important Loanable Fund Theory of Interest. So let's get started with the same. Coming to the idea of Loanable Fund Theory of Interest, this is a particular theory that explains the way in which interest rates are determined in the financial market. So, as far as this Loanable Fund Theory is being concerned, it tells that the interest rate this is something that we can determine by considering two aspects. First is demand for loanable funds. And the next aspect is supply of loanable funds. So with these two aspects, with the demand for loanable funds and supply of loanable funds, we'll be able to determine the interest rates when it comes to financial markets. So this is a basic idea of Loanable Fund Theory of Interest, and we are going to look on to the key important aspects of Loanable Fund Theory of Interest. Let's proceed to that. Moving on to the idea of supply of loanable funds. So what is it all about, the supply of loanable funds? The supply of loanable funds would represent the total amount of savings available in the economy that the lenders are willing to lend out. So what happens when you have your income, which is represented as Y, this income is spent on consumption, which is represented as C, and again, this a part of your income would be saved, which is represented by ES. So Y is equal to C plus S. Now, what happens when your income is something that remains as constant? If your income is constant, you will be having a particular level of consumption and the rest of your income you will be saving. Now, what happens when your income increases? When your income increases, definitely there can be a chance for your consumption to increase as well as saving to increase. But after a particular point, what happens if your income is still increasing? So if your income is still increasing beyond a particular limit, what you could find here is that you need not increase consumption always whenever there is an increase in income, or in this case what happens is that your consumption would be increasing but not as what you could find in the case of income. So what you will be doing here is that you will be saving too much here. Because in this case, you could find that you're talking about an increasing income scenario, an ever increasing income scenario, where you will be consuming a smaller part of your income, but a larger part would be saving, or that would be saved. Now, we could find that whatever be the situation, whatever be your income level, most possibly people will be having a tendency to allocate their income between consumption and savings. So I was telling that we consider the total amount of savings that is available in the economy that the lenders are willing to lend out. So these kind of savings would be coming from certain entities of the economy like the household, business, as well as government entities. So whenever these entities have some excess fund, what they would do is that they provide for loan or they lend it out. Here lending means giving money to others at some interest rate. So this is all about the supply of loanable funds. When you have some extra income or when you have some money which is something that you're saving, it would be better for you to lend it out. so that you will be getting some interest rate. The amount of income that you are having which is beyond your consumption level, or which is beyond the amount that you spend for consumption, this is what you're saving. So this saving is something that you can utilize for lending so that you will be getting some interest rate. So that's the entire idea of supply of loanable funds. Now, we want to consider the other side. That is the demand for loanable funds. So what is it all about, demand for loanable funds? This shows the total amount of funds that borrowers are willing to borrow. So we could find that there are certain people who lack enough money. So these people might be wishing to go for some investment, but they are not having enough money. So what they could do here is that these people will be going for borrowing. So these people act as borrowers. So they will be demanding money from those people who have money. And when you consider the demand for loanable funds, the curve would be downward sloping. So this happens that whenever you have low interest, if the interest is less, just think about a bank. The bank is charging a very low interest. So in this context, what happens? If you are a prospective investor, or if you are trying to find a good time for you to invest, you could find this is a good time because the interest rate is very less here. So you think that if I take loan right now, I'll be requiring to pay less in terms of interest rate to the bank. So it's the best option to go to bank and take a loan right now itself at a less interest rate. So like this, several prospective investors, prospective businessmen would be thinking, and they will be taking loans. So the number of loans that would be taken would be increasing. So there exists a kind of inverse relationship between the amount of interest rate that has been charged and the number of loans that would be taken. So here we are talking about the people who require money for not having enough money. Earlier when we talked about the supply of loanable funds, we were talking about the people or some economic entities, either in the form of government or businessman or people, individuals who have got some extra money. Now we are talking about people who are lacking enough money, and for the very same reason they will be borrowing from others. Here also the examples could be individuals, businessmen, or government. So if they lack some fund, they will be borrowing. That's it. Again, interest rate is a matter that influence the amount of borrowing. Now comes the interest rate. Now what happens in the case of interest rate? So interest rate is the price of borrowing money. So that means if you're borrowing money, you have to pay a price. Pay a price to lender. And this is what is called the price of borrowing money. So this interest rate is something in a market economy we could determine by considering the demand for loanable funds and supply of loanable funds. So the demand for loanable funds and supply of loanable funds. This is what, again, these are the things that will be determining the equilibrium point at which you could find some equilibrium interest rate. So let's go for the graphical representation here. So in this case, at x-axis, we will be having the quantity of loanable funds. And here we consider the price of loanable funds, that is interest rate. Now, I told you that we are having an inverse relationship between the demand for loanable funds and interest rate. So this would be an inversely sloped curve, demand for loanable funds. And the supply of loanable funds, it will be positively sloped. This would be supply for loanable funds curve. So at this point, we could find that there is an intersection between the demand for loanable funds curve and supply of loanable funds curve. So this would be the equilibrium point. And from this point, if you draw down, you will be able to get a point Q that shows the equilibrium quantity of loanable funds that is being demanded as well as supplied. And again, when you draw a line from this equilibrium point in such a way that it touches the y-axis, a straight line, you will be getting another point I, which would be the equilibrium interest rate that would be charged for the given quantity of loanable funds. So that would be the equilibrium interest rate. So this would be the equilibrium interest rate. So this is how a market for loanable funds operating with the intersection of demand and supply factors. This is how we determine the interest rate in a loanable fund context, where we do consider the demand for loanable funds as well as the supply of loanable funds. Now, we need to consider various factors that would be affecting the demand and supply for loanable funds. The first aspect is called saving rate. So I told you that if you are having more savings, if your income is more, you might be having a tendency to save more, right? So saving is more means there would be more people who would be ready to lend. So lenders would be more. Lenders would be more. So what happens to loanable fund scenario? Here we talk about a context of more supply of loanable funds. So that means the loanable funds supply would be increasing, or the supply of loanable funds would be increasing. Now comes the rule of investment opportunities. Just assume that the government is actually giving some subsidies, or the government is providing some tax breaks for the people who are ready to make investment. That means the opportunities to make investment is better, or else we could find that the investment climate is better. Investment climate. So there are some good factors promoting investment. So you could find that all the surrounding for making investment is good. In that case, what you will be doing is that you think that you would also go for investment, but unfortunately, what would happen if you're not having enough money right now in your hand? So if you're not having enough money in your hand right now, when there is a good investment climate going on, so what will do here is that definitely you will be demanding money. Your demand for money increases, right? Demand for money or demand for loanable fund. Loanable fund increases. So what happens to you? You will be increasing your borrowing, or people will be borrowing more, or more number of people will be borrowing. So in this case, there is a pressure that is being applied to loanable fund from the demand perspective, and that might lead to increase in interest rate. So interest rate can increase. So this can lead to rise in interest, because many demanding side people are there, or many people are there in the demanding side. Many people are coming to bank to take loan. And what will happen if the bank is not having enough money, enough fund to supply to these demand side perspective holders? Or what would happen to the bank if the bank is not able to find enough money, enough fund to lend it out to all the people who come to bank to take loans? So in that case, automatically the interest rate would be increasing. Now, coming to the next factor influencing supply and demand for loanable funds, this is the government borrowing. So what happens if the government is increasing its borrowing? Government is increasing borrowing means definitely there will be a clash. Borrowing of government increases, because we are dealing with a scenario of limited financial resources. So this might be making a competition between government and private entities for fund. Again, the demand side is moving up. Again, the higher demand for loanable fund would definitely lead to increased interest rate, because now the government is borrowing more, and that will be reducing the amount of loan available to the private people. Private people would also be demanding more loans. Altogether, demand for loans would be more, and this will be pressurizing the interest rate. The interest rate will go up, because this is the price of borrowing money. What will happen when there is a context where aggregate demand for a commodity is increasing, at the same time aggregate supply is remaining the same if it is constant? So in this case, what we could find here is that definitely the price of the good will be increasing, right? There would be inflation happening in the economy. The same logic has been applied to the loanable fund market also, so that you will be able to understand the entire context. Now, what is all about market efficiency, and what is its role when it comes to influencing supply and demand for loanable funds? So market efficiency aspect considers the financial market, the competitive aspect of financial market, the efficiency aspect of financial market, where interest rate would be adjusting. So here also comes the demand and supply. How is the demand and supply moving, or how would be interest rate adjusted with the movement in demand and supply? How soon interest rate would respond to the changes in demand and supply of loanable funds? So if the interest rate would capture this change very soon, once this change has occurred, and if the interest rate is able to reflect this change in the loanable fund market as soon as possible, that means the market is efficient. Otherwise, if the interest rate is taking time to make a reflection of the changes of demand and supply of loanable funds, definitely that is a matter of inefficiency. Now, having discussed all about loanable fund aspect, the demand of loanable fund, the supply of loanable funds, the market mechanism, as well as the factors influencing the demand as well as supply of loanable funds. Now let's consider the implication part. So we could find that the demand and supply of loanable funds would be the basic aspect that we have to consider here. So whenever there is a change in monetary policy, whenever there is a change in fiscal policy, whenever there is change in savings behavior and investment opportunities in the nation. Definitely, all these would be affecting the demand as well as supply of loanable funds. For example, what happens if people are saving less? If saving is being less, then definitely supply of loanable fund would be less. Supply of loanable fund would be less. So like that, every important variable that we have considered here would have some implication on the loanable fund scenario in the market. And we could understand that various economists, policymakers, etc., they would analyze the movement of this interest rate in the loanable fund market, and they would actually they would see how this has been influencing the various decisions that we take, the investment decisions, the decisions regarding saving, decision regarding consumption, decision regarding economic growth, and then these policymakers would be formulating policies, or else we could find that after getting these data, the policymakers would be making appropriate changes in their policies so as to influence the market, so as to influence the economy in a positive sense. So that is all about the idea of loanable fund theory of interest. Now you can download the Oikonomia app where you will be getting previous year question papers and answers. We'll be getting free study materials, live as well as recorded classes, and free MCQ based weekly tests. The only thing that you can do is just download the Oikonomia app. I'll be providing the link of the same in the description box. Also, you can be a part of a free Telegram community. Just one thing to do, just click on to the link that I'll be providing in the description box. So that's it. Kindly like, share and subscribe to this channel for more videos, and thank you for watching.